Hello, welcome to Rational Investing. My name is Cameron Stewart, CFA. Thank you very much for watching the channel. All the comments and subscribers, I greatly appreciate it. I really do. This week up, we're going to take a look at Unilever. Unilever is the giant conglomerate that owns everything from dryers, ice cream to Dove bars. We're going to take a look at their cash money, how much money they make every single year by selling their product, look at it forward and see what we can forecast this business for. And if we hold it now for another decade, can it make us money? And can we beat the stock market by buying the stock? You ready? Let's get to work. Okay, we're going to review Unilever this time. Before we do that, let's review the 5 key attributes that we use to value all the stocks here at this channel. Number 1, top line revenue growth. We've got to have it. Number 2, EBITDA, enterprise level earnings must be growing. Number 3, strong free cash flow, the hallmark of all great companies. Number 4, low debt. We want to see low, less than 3 times debt to EBITDA. And number 5, a well-priced stock. Well-priced, that means that we think we can buy the stock today with a conservative forecast, beat the stock market in the next decade. That's what we mean by well-priced, something that's effectively going to increase our rate of return above the market. That's what we want. That's how I define well-priced. Now, this channel is dedicated to the rational investor, that investor that's buying cash money. We're not speculating. There are no bulls and bears dancing across the screen here. There's no red and green lines flashing on and off. We're looking at reading 10Ks. We're reviewing a decade's worth of material and finding out how much cash does this business actually make, how much debt is it producing, and is it sustainable for the long term? That's what we're focused on. That's what we're going to do. Let's dive right into Unilever, which is this week's company. All right, before we dive into the financials, just want to show you the portfolio. This is in the United States. They have investor relations presentations that they give for Asia, Europe, and the States. This is States being the most familiar brands that they own for the U.S. consumer. They do this same presentation for Asia and Europe as well. But for me here in the U.S., Dove, Ben & Jerry's, Dryers, Dove Men's Care, Tresemme. These are huge brands that they own. Lipton Tea, obviously a huge one. And Tanso Tea as well. Very big brand. So I just want to give you an idea of what they own. It's a portfolio of consumer products. Let's go dive into the financials and see what they have. All right, the very first thing I like to focus on is revenue, right? So I've got Unilever up here. Now I've converted all these numbers into USD. Their home currency is the euro, so there's a little bit of currency translation here because I'm a U.S. buyer. I want to look at euros in dollars. So these are dollars in millions. And I've converted the numbers at the average exchange rate over the year. And what I saw very quickly here is that revenue from 2013 at $68.5 billion has declined to $59.7 billion over this 9-year time frame. And that's a 2% annual decline over this period of time. Even averaging these and averaging those, it's relatively flat, which is not what I would have expected. I want a nice steady growth, even if it's 2-3%, at least keep up with inflation. This negative number is a problem for us. We're going to see how it affects the business going forward. The next thing we want to review is EBITDA. Now, EBITDA is our earnings metric, and we want to see enterprise level earnings grow, not earnings per share, which can be manipulated by the share buyback program they do. We want to see the company itself grow earnings. Then they can buy back shares and grow earnings faster. But at the bare minimum, they need to grow earnings. And they do slightly. 1% annualized rate of return, starting with around $12 billion here in 2013, ending with about $13 billion in 2021. If I average these periods, I get kind of the same growth rate. I mean, it's definitely growing. There's margin creep here, which is nice. With revenue declining and earnings growing, you can only do that for so long, though. At some point, you're going to have to grow revenue. And their business model is basically been switching out dying brands, selling off dying brands, and going on acquiring growing high-margin brands. And that exchange, that selling off of one portfolio and buying another portfolio has really left them revenue neutral, but they've been able to pick up higher margin brands, which is lifting their earnings a little bit. But that's not really a strategy that's going to drive revenue growth or really give you that hockey stick return that you're looking for, at least that I'm looking for when I buy a company. So we're going to take this note, we're going to move forward to enterprise value. Now, enterprise value is the entire value of the business. Why is it important? Because the stock market trades the equity portion, the market cap, just the equity of the business. There's a giant piece of debt on the company that is not represented by the stock price, and we want to look at them together. Much like the price of a home, the enterprise value is the market price of a home. You put down an equity piece that's a small piece of the home. You go to a bank, you borrow a mortgage. That debt is big and meaningful. Companies are the same way, and we want to make sure that a company is not overly leveraged or has too much debt on it. And what you're going to see here when I look at short-term and long-term debt for Unilever, and these are bonds or lease obligations. They start with $15 billion and they double it to $34 billion in 9 years. That's a big move, especially in a company with essentially flat earnings, certainly on a real basis relative to inflation, yes. But they grew it at 1%, revenue fell 2%, debt doubled. So not a great opener. Let's see what it's trading at, and maybe it's super cheap. But let's keep going and get enterprise value. So then excess cash, they do have excess cash, but not nearly enough to offset the debt that they have. So I think this cash would probably be better deployed buying down debt or going out and doing something useful with it rather than sitting on a balance sheet. Market cap has gone from $120 billion to $140 billion over this time frame. Really not much of a move. Enterprise value, $135 billion. Increased to $173 billion, largely actually from the increase in debt, actually kind of debt and market cap. There's $20 billion here, $15 billion here. That's making up the $40 billion gap over there. So really it's a combination of increasing debt and increasing stock price that is giving this company a lift. When I look at the debt itself, they started the decade at 1.2 times leverage. That means I'm taking debt less the cash. I'm netting these two for how much debt they truly own. And I'm dividing by their earnings, how much money they make on an annual basis here, $11 billion that they make every year, at least that year in 2013. In terms of debt, they had about 15.8, that's 16 minus 1, call it 15 billion. So if they have $15 billion of net debt, they make $11 or $12 billion a year at that time. That's roughly 1.2 times debt to earnings ratio, which is cheap. That means they can operate for 1 year and pay off all their debt, which is what we want. The interesting thing is, as earnings are flat and debt doubled, this ratio doubled over time. So now it's bumping up against 2.6. Remember, our hurdle is 3. We don't want anything greater than 3. That's really when you start going away from senior secured debt and you get into second layer like Series B or unsecured debt or subordinated debt, which is more expensive. And it really starts representing a risk to us, the equity owners, especially in this rising environment that we're coming upon. We really don't want to buy companies with lots of debt. But right now it does qualify, it does check the box, although I don't like it. EBITDA, enterprise value to EBITDA multiple, this is the payback period. This is how many years the company needs to operate to essentially buy itself. And you want something that's cheap, right? You want something that you could buy, you get your cash back, theoretically, cash back very, very quickly. Certainly, with this company not growing, you would expect this to be, I would expect it to be single-digit EBITDA multiples. But here, it starts at 11.5 on the low, and it kind of bumps up against almost 15 on the high, come down a little bit. 13.5 to me is a rich multiple for a company that's not really growing and has more debt. So I would expect this multiple to come down over time, especially in this market where I think just in broad generalities, the entire market is bringing multiples down. So here, this is the general revenue, EBITDA, enterprise value. Let's go look at cash flow where the rubber meets the road. Before we move to cash flow, I want to remind you that I teach a course on how to value stocks at cashflowinvestingpro.com, where I give you this Excel sheet. I give you the 10 case for Apple. I show you how to put it all together, how to pull the data. Definitely check it out, cashflowinvestingpro.com. Okay, so here we are with the cash flow statement. First, we want to make sure that cash flow is tying to the income statement. And we do that by just looking at the growth rate over time of cash flow from operations. Remember, cash flow from operations is the first third, the upper third of the cash flow statement. If the cash flow is one page, which it typically is, you got the first third is basically cash flow from operations. How much cash money do they make buying and selling their product every day. So they sell Ben & Jerry's ice cream, they pay the staff, they pay the supplier, they pay the boxes, they buy the milk, they grind all the sugar, they ship it to this grocery store, the grocery store sells it. All of that stuff is in the cash flow from operations. That's how much money they make in the business. The next third is the investing section. What do they do with the money? Well, they have the peel out for CAPEX, they make acquisitions, and they sell the companies, their portfolio companies. That's the middle section, the investing section. The bottom section is the financing. Do they pay a dividend? Are they borrowing or paying down debt? Are they buying stock, issuing stock? That's the section in the cash flow statement. We want to pick up here with the cash flow from operations section. And what you can see is it's flat, roughly 1% growth, which ties to the EBITDA growth. So I think the accounting department is representing the cash flow in the business on the income statement, which is a good good check of the income statement. I like that. I just don't like the growth rate. So it's very, very weak. CAPEX is the amount of money, the cash money, that they have to put back to keep their factories running. New paint on the wall, new conveyor belts, new enterprise software systems, employee training, laptops, all that stuff that you need to run the business is here in the CAPEX. It stands for capital expenditure. They just abbreviate CAPEX. But basically, I like looking at the spread here. They made $9 billion selling their products. They put 1.4 back. They kept, $7.6 billion of cash that they could use to pay down debt or dividend out, which is a good thing. So then the debt payments. Debt payments here, largely positive. You'll notice these numbers. Now this is principal inflows or principal outflows. Outflow if I pay down debt, like paying your mortgage, or positive, I borrowed money. Largely positive means there's largely borrowing money, which incidentally dovetails perfectly well for what we're seeing here with the balance sheet increasing in total debt because they're borrowing. The question is, what are they doing with this money? We're going to find that in a little bit. But they're borrowing money. And so when I look at cash flow to equity is the combination of all of these. That's the technical definition. It's just the sum of CFO CAPEX and the net debt payment. And you can see it's very large and positive, mostly on the back of this giant debt payment. But on whole, it's been growing about 3%, again, mostly because the debt has been growing 3%. What do they do with this? Well, they've been buying back shares. You can see shares have come down 1% annually over this time period, which doesn't sound like a lot, but 1% is. Certainly for a multi-billion-dollar company, them to come out of pocket and buy shares, it costs them a lot. So they're just under 3 billion shares, 2.9 billion shares. Fast forward 2.6, so they've bought almost 300 million shares. Whew, that's a lot. That's a lot of jack that they're spending. Well, let's make sure that they're making the money they can keep it. So shares, I divide these two, I get a free cash flow per share. Now this number right here is exactly what the company is based on. The future number here is what today's price of a stock is truly worth. The whole stock market itself, the moving and back and forth and everything, is just everybody's estimate of what this number is going to be next year, the year after that, the year after that, the year after that. And the interesting thing is, it's much more certain to estimate this number next year than it is 10 years from now. And that's why high growth stocks have a very high multiple or can swing wildly, as you're seeing with Zoom, for example, down 70%, Shopify, these massive growth companies. Everyone's trying to estimate what this number is going to be out in 10 years. And when something changes in the market, that estimate drastically changes and the value of the company instantly changes. So it's very important you try to find a company that's got a stable pattern of this with a conservative forecast and you buy that on a cheap basis. That's a good way to bank cash over time and let your portfolio compound. But I digress. Then the share price, and I divide these two for a yield, and you want to buy something that's got a good yield. There's a couple times we found things that are like 10% yielding cash flow companies that we've bought, and they've gone up as people realize that they were really cash generating machines. But that's what we kind of look for here in the channel. Now again, I want to remind you that I do provide one-pagers like these on all the stocks that I review here on this channel, but also I release probably a dozen other stocks during the month that I think are interesting, both things that you should be buying, things you should avoid, and lessons to be learned on my website at cashflowinvestingpro.com. Okay, so now we know several things. One, revenue is declining, EBITDA moderately growing. Cash flow seems strong. These numbers here are very robust. They're buying back shares. What else do we do? I was going through the CAPEX statement, I was going through the cash flow statement because something didn't make sense to me. And what I realized is their portfolio of products is ever churning. What that means is they're buying and selling assets, and they're buying an awful lot of companies. And if they're buying companies, why isn't revenue growing? And that was bothering me. So I made a new chart, and I want to take a look at their cash flow from operations, CAPEX, the amount of money that they're buying companies for, their acquisition cash, the amount of money every single year that they use to go out and make acquisitions. Then I took the dividend payment that they make because they're such a dividend stalwart that I want to know, can they afford this dividend? Because that's all the true cash that they're putting out. Cash flow from operations, what they make selling the product, the CAPEX, what's required to put back in the business. The growth acquisitions. Now, they make growth acquisitions every single year. If they've been doing this every single year, this is $33 billion, by the way, of growth capital that they've put out there. But they have not been able to grow revenue. That's a problem, and that means that in order to maintain the revenue that they have, just steady state, they need to be able to put this kind of acquisition cash out there. So it's kind of like a CAPEX that they need to do. And so I want to include that. Next, I said, here's the dividend they're paying out. They've always been growing the dividend more and more. And then what's the net? Just the sum across here. And what I realized is the net is negative $11 billion. Now, I think they get some cash actually when they sell. This is just acquisitions to go buy companies. They're selling some of their portfolio. So they do get cash in, which I think offsets a lot of this negative. But I think when I look at this to me seems like a company that needs to spend money on acquisitions to be showy and show the shareholders that management's doing something. They've got a dividend that, in my opinion, is too large for the type of business they're running if they have to put this acquisition money back. They're also buying back a lot of shares, and debt's growing. So then I looked at share buyback. I said, well, if I took the change in shares, that 1% every year that they're buying, remember, it's $300 billion of shares that they bought back, times the share price in that year, I get a flow of money that they had to come out of pocket, about $15 billion that they spent in the last decade buying back shares. Well, if we already know that they have no cash after the dividend, they're in the whole $11 billion, where do they get the cash to buy stock with? They borrowed it. Change in debt. And what I found fascinating is when I looked at the change in debt and the change in the share buyback program, it's pretty much even. So in net, they gained $300 billion. What that means is that all the money that they spent buying shares was borrowed money. And with interest rates going and with their debt rate rising, it's now doubled earnings, that's going to stop at some point. And when that stops, that's going to mean that the enterprise level earnings, the EBITDA that's growing at 2%, is going to translate all the way through to the share price because they're not going to be able to buy shares to artificially inflate that. So the growth per share, the EPS growth in this company is going to fall. Okay, so this is a nice deep dive into the mechanics of how share buybacks work and how a company such as Unilever is borrowing money to buy back shares and artificially lift their EPS number. And it's not what we want. That's why exactly we look at the enterprise level. They have to be able to grow the enterprise. Otherwise, it's not something we're interested in. Let's forecast this business, take a look, and see what it's worth. Okay, so a forecast is pretty simple. I'm going to go 2.1% over the long term because that's basically what they've been growing their EBITDA historically. Again, knowing that they're buying and selling their own businesses, it takes them from $13 billion to $16 billion over time. I put a 12 handle market multiple on it, which is going to bring it down. That should even be around 10, frankly. But I have a 12 handle in there right now. $191 billion of enterprise value, less some debt plus some cash. It means 150 market cap, 150 billion market cap. Divide by the shares outstanding is $57.22 per share. Okay, now I can do the same thing for free cash flow. I take free cash flow. That's cash flow from operations minus CAPEX. I put the debt aside for a minute. Because the debt's been growing, we know we can't grow debt forever. That's $3 a share. I grow that at the same rate I grow EBITDA, and I get $3.61 over long term. I put that against a 7% yield, and I got a $51 price target. Now, I want to show you something very interesting here. This is cash flow from operations less CAPEX for a traditional cash flow number that I use. But what we said earlier is they buy a lot of companies to prop up earnings because they can't grow their existing brands. Well, what does that mean? Well, that means that if I look at CAPEX plus the money they put into cash acquisitions, then my per share figure drops to $1.49 from $3. So this number here is $1.49, not $3. Basically having it in value. And that means the share price goes to $25, not the number we had previously, which is 51. Now I'm going to leave the 51 here because I'm sticking with the traditional formula here. We'll get to there's a point here, I'll get to it in the future, but I just want to show you that if I include the cash needed for acquisitions as part of an ongoing assumption the business must spend it to maintain their 2% growth, that means their free cash flow is actually half what is advertised. Okay, so now we have two price estimates. Again, I'm going with the traditional cash flow from operation less CAPEX number. So I get $51 and $57, one from the free cash flow method, one from the market multiple method. I average the two, $54 a share, right? I can buy all the stock I want right now for $53 a share. If I pop all this into an IRR calculator, I'm in for $53. I get a pro rata share of cash flow, and I'm at a 7% IRR, assuming the higher free cash flow. If I were to reverse this back down, this would be near zero, which is not what we want. So for us, well, let's recap and see where we are. Okay, let's recap. Number one, a top line revenue growth. No, I'm not check the box. Not growing. EBITDA, technically, yes, it grows. Free cash flow. No, I'm not going to give it a strong because of the acquisition money that's there. I'm not going to say it's strong. It's basically a dividend machine, and they can't afford to grow. Debt, I can check the box because it's less than 3 times, but it's growing. I don't like that. And well priced, no, I'm not going to check the box because it just doesn't. It's not going to beat the market. And that's ultimately what we're trying to do here. You have thousands of stock out there. All right, you think of an index fund, for example. You've got the top performers in index fund. You've got the bottom. And if you own the index, you basically become average. Well, I want to find just the top performers and own those. So I have to be very, very picky with what I buy. So this one doesn't fit the bill. I'm going to give it a bad investment. I don't think it's something that warrants your cash. It should be a whole lot cheaper than it actually is. If you want to learn how to do this type of work, because there are thousands of stocks that no analyst can even cover, there are so many, take my course, cashflowinvestingpro.com. I will teach you how to become a securities analyst. I'll give you this spreadsheet. I'll walk you through the 10 Ks of Apple. We will assemble revenue and EBITDA, free cash flow, CAPEX. I will show you how to forecast. We'll show you yields and market multiples. I'll show you share buyback program, how to calculate the fully diluted shares, and we'll build a forecast, and you can have an estimate for what you believe the IRR, return of investment, will be. And if you have that knowledge, you'll be much more grounded in when the market goes sideways because you have a thesis on why you bought the stock to begin with. All right, that's my plug for cashflowinvestingpro.com. Thank you very much. Please check out some more videos. They're going to come up here on either side of me. There's lots of reviews that I've done over 100 different companies. Check them out. Hit the subscribe button. Really appreciate that. Throw a like or a comment down below. Tell me what stock you want to see next. Again, thank you very much. Take care. Bye-bye.